Gold is falling today, and if you just checked the price and felt your stomach drop a little, you are not alone. Millions of Americans are watching the same number right now and asking the exact same question. What in the world is happening to gold on June 11th? Welcome back to AG John Market, the channel where we break down gold and silver in plain English that anyone can understand. Today we are going all in on this question, because the answer is not as simple as most people think, and the full picture is something the mainstream financial media is not giving you. So if you want to understand not just what is happening today, but why it is happening, and what it could mean for the weeks and months ahead, then you are in exactly the right place. Let's get into it right now. First, let me paint the picture of where we are on this June 11th. Gold has been on one of the most impressive runs in recent memory. We are talking about a metal that has pushed through price levels that even the most aggressive analysts were hesitant to forecast just 18 months ago. Record highs, new breakthroughs, constant momentum, and then today, the price starts moving in the wrong direction. If you are a long-term gold investor, this feels uncomfortable. If you are someone who just recently started paying attention to gold, this might feel downright alarming. But here's what I want you to hold on to for the next 22 minutes. A falling price on a single day is not a verdict on the future of gold. It is a data point. And like all data points, it only makes sense when you see the full picture around it. So let's build that full picture together. To understand why gold is falling today, we need to understand what drives gold prices in the first place. Because gold does not move randomly. It does not flip a coin each morning and decide whether to go up or down. Gold responds to real forces, real events, real shifts in the financial world. And once you understand those forces, you will never look at a gold price move the same way again. The first and most powerful force that moves gold on a day-to-day basis is the United States dollar. The relationship between gold and the dollar is one of the oldest and most consistent in all of financial markets. And it is beautifully simple once you understand it. Gold is priced in US dollars around the world. That means when you want to buy gold anywhere on the planet, you are ultimately dealing in dollars. So when the dollar gets stronger, something very important happens. Gold becomes more expensive for every buyer outside of the United States. Think about a Japanese investor who wants to buy gold today. If the dollar strengthened against the Japanese yen, that investor now has to spend more yen to buy the same amount of gold they could have bought yesterday. That makes gold less attractive to international buyers. And when international buyers step back, demand for gold drops. And when demand drops, the price follows. This is the dollar-gold relationship in its simplest form, and it is one of the key reasons gold is under pressure on June 11th. The dollar is showing some strength today, and gold is feeling that pressure in real time. Now here is where it gets interesting. The dollar does not strengthen in a vacuum. Something caused the dollar to move today, and that something is almost always connected to the second major force acting on gold right now. Interest rates and US Treasury yields. This is the part that trips up a lot of beginner investors. So I am going to take my time and make sure you really understand this. The United States government borrows money by selling bonds called Treasury bonds. When investors buy these bonds, they earn a return called a yield. Think of it like interest on a loan, except you are the one lending money to the government. Now here is why this matters for gold. Gold is what investors call a non-yielding asset. That means gold pays you absolutely nothing while you hold it. No interest, no dividend, no coupon payment. You buy it, you hold it, and the only way you make money is if the price goes up. Treasury bonds, on the other hand, pay you a steady stream of income. So when Treasury yields are rising, investors face a very real choice. Do I hold gold, which pays me nothing, or do I hold Treasury bonds, which are now paying me a meaningful return? When yields are low, that choice is easy, because bonds don't offer much either, so gold looks relatively attractive. But when yields are rising, the math starts to shift. Some investors look at their gold holdings and say, I can earn a real return with bonds right now. Why am I sitting in something that pays me zero? And they sell gold to buy bonds. That selling pressure shows up in the gold price. And that is exactly the kind of dynamic that can contribute to a day like today on June 11th. When the market gets signals that interest rates might stay elevated or that yields might rise, gold feels it almost immediately. Now I want to go even deeper on this because there is a layer to the interest rate story that most beginner investors never hear about. It is called real interest rates. And understanding real interest rates will make you a significantly more sophisticated gold market observer. Here's the concept. There is a difference between the stated interest rate, called the nominal rate, and what that rate actually buys you after you account for inflation. That adjusted figure is called the real interest rate. And here is the key insight. Gold does not actually care that much about nominal interest rates. What gold really tracks is real interest rates. When real interest rates are negative, meaning inflation is eating up more than what bonds are paying you, gold is extremely attractive, because even though gold pays nothing, it holds its value better than a bond that is effectively losing ground to inflation. But when real interest rates are positive, meaning bonds are paying you more than inflation is taking away, gold has competition, and it tends to struggle. On a day like June 11th, if the market perceives that real rates are moving in a direction that makes bonds more competitive with gold, you will see selling in gold. That shift in perception can happen in an instant. A single economic data release, a single statement from a Federal Reserve official, a single inflation reading that comes in different than expected. Any of these can move real rate expectations in a matter of seconds, and gold feels it immediately. This is the invisible hand that moves gold in ways that confuse a lot of people. And now you understand it. Let's talk about the third major force acting on gold today: profit taking. This one is the most human of all the forces we're going to discuss today, because it comes down to basic human behavior. When an asset goes up significantly over a period of time, investors who bought early are sitting on substantial gains. At some point, those investors decide to cash out and they sell their gold, lock in their profits, and move that money somewhere else. This is not panic, this is not fear, this is not a loss of confidence in gold. It is simply investors collecting what they earned. But here is the thing about profit taking. When enough investors do it at the same time, the selling pressure can be quite powerful, and gold has given investors a lot to profit from recently. A significant number of people who bought gold at lower prices are now sitting on gains that would have seemed remarkable just a year or two ago. When those people decide to take chips off the table, even temporarily, the market feels it. And on a day like June 11th, when you combine dollar strength with yield sensitivity and profit taking all happening at once, you get a meaningful drop in the gold price. That is the mechanics of what is happening today. Three separate but connected forces, all pushing in the same direction at the same time. Now let me explain why this is important for you to understand, because the explanation for today's drop actually contains some good news. None of these three forces, the strong dollar, the yield dynamics, the profit taking, none of them represent a fundamental change in the gold story. They are surface level forces. They are real, they are powerful in the short term, but they do not reach down and change the deep structural reasons why gold has been moving higher. And that distinction matters enormously for how you should think about a day like today. Let me explain what I mean by the deep structural story. The structural story for gold is built on several pillars that have been in place for years and are not going anywhere. The first structural pillar is global central bank buying. This is the story that most financial media glosses over, but it is one of the most important developments in the gold market in decades. Central banks around the world, particularly in Asia and the Middle East, have been buying gold at a rate not seen since the early 1970s. We are talking about the financial institutions that manage the reserves of entire nations, the people who understand monetary systems better than anyone on earth, and they are choosing to hold gold. Not because of a daily price movement, not because of what happens on any given June 11th, but because they are making strategic decisions about how to protect national wealth over decades. When central banks buy gold at this pace, they are sending a signal that goes far beyond any single trading day. They are saying that gold is a critical component of financial security in a world that is becoming more uncertain. And those purchases do not disappear on a down day. They continue, quietly, consistently, building a floor under the gold market that the daily price movement sits on top of. The second structural pillar is de-dollarization. This is a complicated word for a relatively simple concept. For decades, the US dollar has been the dominant reserve currency of the world. Almost all international trade is settled in dollars. Almost every central bank holds significant dollar reserves. This gives the United States enormous power and influence in the global financial system. But in recent years, a growing number of countries have been quietly looking for ways to reduce their dependence on the dollar. Some of this is political, some of it is economic, but the trend is real, And when countries want to hold something other than dollars as a reserve asset, gold is one of the most natural choices. It cannot be sanctioned, it cannot be frozen, it cannot be printed by any government, it is neutral, portable, and universally recognized as a store of value. De-dollarization is a slow trend, but it is accelerating, and it represents a long-term structural source of demand for gold that does not care what happens on June 11th. The third structural pillar is inflation. Yes, the official inflation numbers have come down from their peaks, but inflation has not gone away. Americans are still paying more for groceries, more for housing, more for everything that matters in daily life. The purchasing power of the dollar is still being eroded, just more slowly than it was a couple of years ago. And gold has been the historical answer to inflation for thousands of years, not because someone decided it would be, but because gold cannot be created out of thin air. You cannot print more gold the way a government prints more currency. That scarcity is what makes gold valuable when paper money is losing its purchasing power. As long as inflation remains a concern for American families, and the data suggests it will for the foreseeable future, gold has a fundamental role to play in protecting wealth. The fourth structural pillar is geopolitical uncertainty. We live in a world right now where the headlines change every single day. Trade disputes, military conflicts, diplomatic tensions, economic competition between superpowers. Each of these creates uncertainty, and gold is the asset that people have run to in times of uncertainty for as long as recorded history goes back. There is a reason gold is called a safe haven. When the world feels unstable, investors want to hold something that will not go to zero, something that has intrinsic value, something that governments cannot control. Gold checks all of those boxes, and geopolitical uncertainty is not going away. If anything, the global landscape is more complicated and more uncertain than it has been in a generation. That uncertainty does not disappear because gold pulls back on a Tuesday in June. It persists, and it continues to support the fundamental case for gold at a structural level. Now let me connect all of this back to today's price action. What you are seeing on June 11th is a short-term reaction to short-term forces. Dollar strength, yield dynamics, profit-taking. These forces are real, they matter in the moment, and they can cause meaningful price moves on any given day. But they are operating on top of a structural foundation that is still very much intact. And here is what history tells us about these kinds of moments. Every single major bull market in gold history has had days exactly like today. Days where the price fell, where the headlines got nervous, where beginner investors started to question everything, and in almost every case, those days turned out to be temporary interruptions in a larger upward trend. Not always immediately. Sometimes the pullback lasted a few days, sometimes it lasted a few weeks, sometimes gold consolidated sideways for a while before finding its footing again, but the structural forces that were driving gold higher did not go away, and eventually, the market refocused on those forces, and the trend resumed. Now let me be very clear about something important. I am not telling you that gold is guaranteed to go up from here. No one can tell you that. Markets are unpredictable in the short term, and anyone who gives you certainty about where gold will be next week or next month is telling you what you want to hear, not what the data actually says. What I am telling you is this: the fundamental case for gold, the structural story, the long-term forces that have been driving this metal higher are still intact as of June 11th. Today's drop is explainable, it is understandable, and it fits a pattern we have seen many times before in gold market history. So what should you actually watch for to know whether this pullback is healthy or something more concerning? Let me give you a framework that experienced gold investors use. The first thing to watch is support levels. Gold has price zones where buyers have historically stepped in and defended the price. These are called support levels, and they act like a floor under the market. If gold pulls back and holds above these key support zones, that is a sign of underlying strength. The buyers are still there, they just waited for a better price. But if gold starts breaking decisively below multiple support levels, staying down, failing to bounce, that is a different signal entirely. That could mean the selling pressure is more significant than a normal profit-taking pullback. Right now, as of June 11th, watching whether gold holds its key support levels is the most important technical exercise you can do. The second thing to watch is the dollar. If the dollar's strength today is temporary, if it starts to fade back, gold will likely stabilize and recover. But if the dollar continues to strengthen over the coming days, gold will likely remain under pressure. The dollar and gold are connected at the hip in the short term, so the dollar's next move will tell you a lot about gold's next move. The third thing to watch is what the Federal Reserve does and says. The Fed has more influence over gold than almost any other single institution. When the Fed signals that interest rates will stay high for longer, gold tends to struggle. When the Fed signals that rate cuts are coming, gold tends to celebrate. Any Fed communication in the days following June 11th will be worth paying very close attention to, because the market will react to those signals, and gold will react with it. The fourth thing to watch is inflation data. If inflation comes in higher than expected in upcoming reports, gold gets a tailwind, because that means the Fed may not be able to cut rates as quickly as hoped, and it reminds investors why they hold gold in the first place. If inflation keeps cooling faster than expected, gold may face more headwinds in the short term. These are the four variables that will determine whether today's June 11th pullback is a brief pause or something that lasts longer. Now let me talk about the bigger picture one more time, because I think this is the most important thing I can leave you with today. Gold's story is not written in days. It is written in years. The investors who have made the most significant gains in gold are not the ones who tried to trade every daily move. They are the ones who understood the structural forces, believed in the long-term thesis, and held through the volatility. Every day that feels scary, every headline that feels alarming, every June 11th where gold drops and people start to worry. Those days are part of the journey. They are not detours from the gold story. They are chapters in it. And the investors who understand that, who can see a down day as a data point rather than a disaster, are the ones who are positioned to benefit when the bigger moves come. Let me also speak to you directly if you are someone who is brand new to gold. Maybe you started paying attention to precious metals recently. Maybe someone told you about gold, or you read something that got you curious, and now you're watching gold fall on your very first week of paying attention, and wondering if you missed something. Here's what I want you to know. You did not miss anything. The gold story is still unfolding. The structural forces we talked about today, central bank buying, de-dollarization, inflation, geopolitical uncertainty, those are not going away next week. They are long-term forces that will take years to fully play out. A single day's drop does not change the opportunity. It may actually be presenting an interesting moment for those who have been waiting for a better entry point. Again, that is not financial advice. Please do your own research and consult a qualified professional before making any investment decisions. But from a market analysis perspective, pullbacks in strong uptrends have historically represented opportunities for long-term investors, and the long-term trend in gold, driven by everything we have discussed today, is still pointing in one direction. Let me do a full recap of everything we covered today. Gold is falling on June 11th for three primary reasons. The US dollar is showing strength today, which puts mechanical downward pressure on gold because gold is priced in dollars globally. Treasury yields are moving in a way that makes bonds more competitive with gold in the short term, which causes some investors to rotate out of gold. And profit-taking is happening after a significant run higher in gold, which is completely normal market behavior after any strong upward move. These three forces are real, and they are the direct cause of today's price drop. But beneath these surface-level forces, the structural story for gold remains completely intact. Central banks are still buying at historic rates. De-dollarization is still accelerating. Inflation is still above where it needs to be for Americans to feel truly comfortable. Geopolitical uncertainty is still elevated, and the supply of new gold is still constrained. None of that changed today. The floor that these structural forces have built under gold is still there, and the key things to watch going forward are whether gold holds its support levels, what the dollar does next, what signals come from the Federal Reserve, and what the upcoming inflation data tells us. Those four variables will shape the short-term direction of gold from here, and we will be here covering every development as it happens. This is AG John Market, and thank you for spending this time with us on June 11th. If you learned something today that helped you understand the gold market better, please hit that like button right now. It helps more Americans find this content when they need it most. Drop a comment below and tell me what you are thinking about today's gold move. Are you seeing this as a buying opportunity? Are you holding steady? Or are you stepping back and watching from the sidelines? I genuinely want to hear from you. And if this channel has been giving you value and you haven't subscribed yet, please do that right now. Because we are here every week, breaking down gold and silver, explaining the forces, cutting through the noise, and giving you the kind of analysis that helps you make sense of what is happening in real time. Gold is falling today, but the gold story, the real gold story, is far from over, and the best chapters may still be ahead.